All right. Good evening, everybody. Let's go ahead and get started. Want to welcome you guys here. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just to let me know that that is indeed working. Looking forward to our webinar. I've been really looking forward to this one. We're going to do a live demonstration on the Iron Condor strategy. I'm going to teach you my rules. I'm going to teach you how to do it, like how to take these trades every day, what conditions, what type of market conditions you should be trading the Iron Condor, and we're going to go over basically what it is. I guess I'm kind of skipping ahead, but I got to show you guys what options are in the first place because I know some of you are kind of complete newbies to it, and that's okay. I've prepared some slides to help the newbies kind of get up to speed, and we've also got some other resources to help you kind of get up to speed with options. And then we're going to get into the nitty gritty of the strategy and how we make money with this every day. So, but it's good to see everybody here. I've been, like I said, I've been very much looking forward to this webinar. Like I said, I want to welcome each one of you who are here live. If you are watching this on the recording, I also want to say hello to you guys too. If you are watching this on YouTube, we want to say hello to you guys too. And if you have questions, feel free to ask those questions in the comment section down below, and I'll answer and read each one of them. So, um, perfect. So if you're here live, feel free to ask as many questions as you want. I wanted to keep this like an open-ended webinar. There are no stupid questions. This is a great space to ask questions. You know, if it's really basic, don't worry about it. I'm here for the basic questions. If you got a more advanced question too, bring it up. That's great. It might confuse a few people, but that is totally fine. But we're going to try to make this the easiest transition into trading iron condors to create daily income. One of the reasons why I love the iron condor so much is because we've basically created a daily income strategy. It's a daily trade. You can trade iron condors on basically any different stock you want. It's I haven't necessarily made this strategy up myself. Like iron condors have been around for a long time, and there's a lot of different ways to do it. I'm going to show you my specific way of doing it. I trade it with just the SPX S&P 500 options chain. That's all I do it with. You can also do it with XSP, which is basically the same thing. And I'm going to show you my rules and how I do it every day. Try to keep it as simple as possible. So let's dive right into it. Before I dive into our demonstration, though, I do need to go over our disclaimer just real quickly. I just need to remind everybody, I'm not a financial advisor. If you need financial advice, please seek an official financial advisor that's registered. I'm just a guy with a YouTube channel and a website, and I'm a trader myself. And yes, I've had a lot of success as a trader, but I'm still not a financial advisor. So I just got to put that up there. The other thing too is past results are not necessarily indicative of future results. So keep that in mind too as I show you different charts and things like that. And then do your own research before you take any trades that you take on your own. So let's go ahead and dive in. So first things I want to I know for some of you here watching this right now, this is like you've been through our course, right? So you know what options are, but I just want to kind of get everybody up to speed. This is a very abbreviated 10 minutes here. I'm going to give you like 10 minutes, 15 minutes here to just kind of get everybody up to speed on what options are. And then we're going to spend the rest of the time going over the strategy rules, how to take the trade, what kind of level of option trading privileges you need with your brokerage, and all that kind of stuff. So, and we're going to answer all your guys' questions. So, first, let's talk about what options are. So, these are contracts. All right. So, when you go out and buy stock, you buy shares of a company, right? Or you can sell shares of a company. And that's what people are usually used to when we talk about the stock market. When you buy shares of a company, you literally own that underlying stock and you have ownership of that company, which is kind of cool. Options are a little different. You're buying rights to a specific strike price or at a specific expiration. So it gives you the ability to buy or sell a stock at a set price. And like I said, every option has an expiration date to it. And that expiration is basically the date when the buyer can choose to exercise his or her right to that option price or that strike price, or they can choose to not exercise if the market's not favorable to the conditions of that option contract. An example of this is if you buy a call option, at like $100 on ABC stock, and ABC stock is currently trending at $95, the buyer of that option probably wouldn't exercise that option because the whole point of the option is to make money if the market goes up. So if the market goes down in the period of time that they owned this option, they're not going to exercise it. Now, let's say that same stock was above $100 at expiration. The buyer of an option would want to exercise that strike price of $100 because the price of that stock is now higher than their strike price, which will then benefit the buyer because they'll be able to make the difference between the current price of the market and where it's at and where they actually bought the strike price. So anyway, that's let's go over this. So an option is just an agreement. It's not the stock itself. It's a contract tied to a stock. That's what an option is. Okay. Anybody can get into this, by the way. Like, if you're not, if you, this is the first time you've traded options before, or you're introduced to options, welcome. Options are super fun. They're awesome. There's so many different ways to trade them. Again, tonight, I'm just going to show you guys my favorite way to trade options. And I think it's one of the easiest way. In fact, the Iron Condor is something you can set up just from your phone. I typically trade on Robinhood. I also trade with Thinkorswim. So I've kind of got two different options platforms. And both of them you can trade just right on your phone. It's something that's super easy and simple to set up. All right, let's continue on. So, an example of an option is, and I just wanted to give you guys a demonstration here. So, it's like buying a house. Think of options like putting a deposit on a house. You basically lock in the price today with the seller, and you decide later if you want to go through it. So, you could put down some earnest money as a deposit on a home. And then if you decided at that later date that you wanted to exercise your right to purchase the home, you could go ahead and follow through with that. Or if you decided you wanted to back out, you could back out. The risk involved is obviously the down payment or the deposit that you put down. You may potentially lose that if you choose not to exercise your right, or yeah, that right at a different date. So there's two different types of options. There's calls and puts. Okay. So a call option is you're basically betting that the price goes up. When you do a put option, you bet that the price goes down. Okay. Calls make money if price goes up. Puts make money if price go down. That's it. So we just want to keep that as simple as possible. So when we talk about calls tonight, that means market goes up. You're hoping the market goes up when you buy a call. And when you buy a put, you're hoping that the market goes down. Okay. So, like I said earlier, buying options gives you the right. You're spending money for the right to exercise at a certain date. When you buy an option, you can choose to use the contract itself or let it expire. Um, let's see. Another key thing about buying options is it's limited risk, so you can only lose what you paid. If you buy an option and you spend $200 on the option contract, as an example, the worst thing that can happen is you lose $200, but there's no risk beyond that $200. You can't lose like an infinite amount of money. The only money you can lose is what you paid for that option contract. This is actually one of the reasons why a lot of people prefer to buy options in the beginning, because that's there's limited risk. The worst thing that can happen is you lose the money that you paid to buy that option. And I think another reason why people like to buy options, especially in the beginning, as they're learning options, is because of the potential if you're correct. There's a lot of money you can make if you buy a call option or even buy a put option. And if you're correct in that direction, there's a lot of money to be made. Usually, I've noticed over time, a lot of traders who started off buying options gravitate towards the selling side, which selling iron condors is what I do. And that's a selling option strategy. We're going to get to that in just a moment. But I just wanted to make sure that we cover some of this basic stuff before we get into that. So here's selling options. So when you sell an option, you're selling obligation. Um, and you have, well, not, you're not selling the obligation, you're selling the contract, which creates an obligation. And you are now obligated to that contract as the writer of that option. You're basically creating the option yourself, and you're saying, "Hey, I'm going to sell this to somebody else." And the benefit you get from selling an option is you collect premium. You make money right away for selling that option. Most people don't start this way. Usually, I've noticed people start off as buyers of options and then they gravitate towards the selling side. And again, that's kind of the strategy we're going to teach tonight. You do take on responsibility, and a lot of people don't want that. No one really wants responsibility. Everyone wants privileges, right? And so that's why a lot of people start off as buyers because they want the privilege of buying options and the opportunity to exercise at a later date. But this one you are obligated, and obviously you are going to be compensated for being a seller. And that's an important part because you will make a lot of money as a seller if you do this correctly. You may be forced to buy shares or sell shares as a seller. Okay, so that's something to keep in mind because you have an obligation now when you sell. Um, and this is the example we're going to use throughout the evening as we go through the whiteboard and as we go through different examples. Um, is an insurance company. When you sell options, you're basically an insurance company. You're the one selling insurance to other people. They're paying you for that insurance. If, like, say you're the insurance company and you sell car insurance and your client gets into a car wreck, you're now obligated to pay that person for their car wreck, right? Like you legally have to pay them out what you're required per the contract for that. Now you are compensated. Obviously, you get premium every month that you collect, or every year that you collect premium from that car insurance that you sold, and so it creates this income. And so that's why I've kind of taught people when I teach options. I think the best place to be is to be the insurance company. We don't want to be the ones buying insurance. And buying insurance obviously is great when the rare thing happens, and it finally happens. Obviously you're really glad that you bought insurance, but the insurance companies make a lot of money, and there's a reason why they make a lot of money, and that's because there's more money in the selling of insurance than there is of buying it. So I hope that example makes sense, and we're going to use that example as we go through the evening. So again, why do people sell options? Obviously, you have obligations when you sell. You collect premium up front. That's the main reason. You're immediately collecting cash that you can use for taking other trades, or it's just money that you can use as income when you're the seller of options. Okay. Time works in your favor. Obviously, if the market doesn't really do anything or doesn't go in the direction of the buyer's set expiration date and set strike price, you're going to collect money as that option decays over time. Okay. It's kind of like, let's say I sell car insurance to you and you pay me $200 this month for car insurance. All right. Now I'm promising you for the next 30 days that if you get in a car wreck, I'm going to cover you. Right. And you're like, oh, that's a good deal, man. Like, I'll give you $200, but you just got to cover me in case my car gets into a wreck and I want to make sure that I'm covered. I'm like, deal. And every day that goes by, I'm realizing more of that $200 of profit because obviously there's 30 days in a month or so. And if a day goes by, I'm feeling more and more confident that I'm going to collect that full $200 premium, and I'm not going to owe you anything. I'm not going to I'm not going to be obligated to pay you because days are going by or weeks are going by and I'm just collecting that money. So let's say day 28 goes by and there's only 2 days left. I'm feeling really confident that that $200 you paid me, I'm just going to collect the whole amount. And then if the other 2 days go by and the full 30 days elapse and you haven't gotten into a car wreck, you're happy because you were covered, but I'm also really happy because I collected premium and, I took on an obligation for that, but I created income from you because I created that obligation. So, rule of time is important. So, selling options, like I said, means you have an obligation. As time goes on, the value over time decays. So, like I was saying in that example, if I sold you insurance, every week that goes by after you've already paid me the premium for selling car insurance, I'm happier and happier, and I'm feeling more confident that I'm not going to owe you anything every day that goes by because I've now collected, and the time is decaying the value of that insurance because it's becoming less and less likely. There's less and less time available for you to get into a wreck. Okay. So you benefit as an option seller as time elapses. And that's why selling options is one of the greatest income strategies is because time is in your favor as a seller of options. Even if a stock doesn't really go anywhere, or even if it slightly goes against you, time is always working against the buyer and it's always working for you as a seller, which is awesome. Like I said, it hurts buyers every day that passes. Sellers are making money, even price doesn't move. So we kind of already talked about that. Okay. And okay, so here's kind of a recap. Rule of time is important. When you're selling options, you have obligations. Buyers equals rights, and you have limited risk as a buyer. Remember, when you buy options, the worst thing that can happen is you lose the premium. Like if you paid me insurance, like if you paid me a premium to buy car insurance, the worst thing that happens to you when you buy car insurance is you just lose the premium that you paid. Okay, that's the worst thing that can happen. Obviously, you can get into a wreck, and obviously, if you get in a wreck, you're gonna call me up and say, "Hey, Steve, I did get in a wreck this month. I need you to cover me, and I need you to pay for my car. I need a new car, and all this kind of stuff, right?" And then obviously, I'll come in there and I'll have to be obligated to take care of you for that. Like I said, so sellers have obligations, but get paid in the process, and time works in the seller's favor. Technically speaking, when you're a seller, if you do not trade very well, you can have unlimited downside risk. Like let's say I sell insurance on an exotic vehicle. Let's say you own a McLaren or you own a Corvette or you own a Lamborghini or something like that. And I'm like, yeah, man, I'll insure that. Like I could be on the hook for a lot of money. So you got to be careful when you're trading these options. You have to know, you have to define the risk. And so one of the things we're going to talk about later is that when you become an insurance company and you sell premium and you sell options, you want to define your risk. And so insurance companies also buy insurance themselves. So even though they're selling insurance to other people, as an insurance company, I also need to have my own insurance in case things get really out of hand. And so I'm going to teach you tonight why the Iron Condor is super awesome because the Iron Condor is a defined risk strategy. So even if things do go the wrong direction, selling Iron Condors, there's limited risk, which is super awesome. So you have a worst case scenario and you also have a best case scenario. A lot of people who have horror stories when they trade options are usually people who, they were the insurance company and they didn't have insurance themselves or they didn't have that downside protection. And so obviously when I trade, I'm always defining my risk. I know my rules. I've set rules that are important to have installed, and I'm really good at following those rules. And so like I said, we're going to teach you those rules in just a second. All right, I think that's about it. So that's all I have for the quick slideshow. Perfect. That's exactly the amount of time I wanted to give that. If you guys have questions on what we just discussed, hit me with those questions right now because we're about to dive in straight into the Iron Condor. And I'm going to go in on how to trade it, why we trade it, and what it is. And I might lose a couple of you in the process. So before I dive into that, if you are new to options trading, like completely new, and you're like, dude, I don't even know what you're talking about. I've actually put together a course on options trading. You can actually watch it on our calendar on our website. We just started it not too long ago. It was the end of January. So we started this on the 26th of January. It's a 10-part series. We're up to 8 classes so far. We have 2 more classes to go in the series. The first class right here goes over what stocks are in much more detail. The second class goes over just calls and puts and what calls and puts are, tons of examples and demonstrations. The next class goes over the Greeks. We talk about theta, gamma, delta, vega, all these different things. And you don't necessarily need to know all those things today. But it would be nice if you could get up to speed and learn these things so that you're more familiar with the Iron Condor and how to trade it and stuff like that. So we're going to do our best to try to keep everybody on the same page as I kind of describe what we're doing and how we make money with this every day. But if you're interested in going through that course, we're going through it right now as a group. We do it every Monday night. Tonight, we're kind of taking a break and we're doing more of a live demonstration on the Iron Condor. And next week, we're gonna go ahead and start finishing that that course, and we're going to restart that course in April and do a brand new. We're going to start with class one, then go to class two and three, and so on. And so if you want to catch the next one, that would be awesome. But in the meantime, if you want to head to our website, go to the calendar and watch some of the recordings, I think that's one of the best places you can start. Okay, so I'm going to do something a little different. I've never done this before. So we're going to do a whiteboard presentation, and I'm going to try my best to put this together. Okay, so let me go ahead and I'm going to stop sharing, and I'm going to go ahead and share again, and we're going to do a whiteboard. If this doesn't work, I have a plan B, so no fear there. We're going to go ahead and give this a shot. And let me pull this up here so you guys can see this. All right, let me know in the chat box, guys, if you guys can see a whiteboard here. Before I do that, I also need to turn off. So this should work. Says loading. Okay, perfect. And we're going to go ahead and, okay, see a whiteboard? Perfect. Awesome. Okay, we're going to give this a shot and see if this will work. So I'm just going to upload a couple of things that I've already prepared to teach the iron condor. Okay. I have this I wanted to pull up, and I also have, I'm going to put this over here, and then I also have one more thing I need to upload. Okay. Okay, actually that just pushed that out of the way. So let's do this. Let's do one thing at a time. Okay. Okay. All right. So what I'm going to do is I'm just going to go over what an iron condor is. So basically, an iron condor is a four-legged option trade, and that might sound intimidating, um, but I'm going to explain what that is in just a second. Let me pull up I have a shape here I need to grab. Let's go straight line. See if I can grab this. Okay, let's see if I can do this. Bear with me here, guys. There we go. Okay. So let's go ahead and make this bigger, and I'm going to drop 4 lines. Show you what this is. Okay. And let's do another one just below that, like this. And let's do another one up here like this. Okay. So an iron condor is a neutral strategy. You're basically betting that the market goes sideways. You want the market to just kind of stay within a range. You don't really want it to go anywhere. Okay. It is also a short volatility strategy. Some of you may know what that means, and maybe some others may not know what that means. But basically, a short volatility strategy means that you're coming from a place where the market is moving a lot, and then you're hoping that the market goes into a regime where it doesn't really move a lot. And the reason why this is important is because when you sell an iron condor with your brokerage account with Robinhood or Thinkorswim, or if you do interactive brokers or Tasty Trade or wherever you trade options, you want this option to expire worthless. Because remember, we are the insurance company. Okay. So think of yourself as an insurance company. You're selling insurance every single day to somebody else. So you're obligated by selling this insurance. And that, again, that might sound like a scary thing, but at the same time, when you're the seller of insurance, you get benefit from that. What's the benefit? You created income because you're selling that insurance to other people. Okay, so let's go over this four-legged trade. So there's basically 4 components, and let me go ahead and type these out. Let me see if I can put this together. And we're going to go over the 4 legs here. So every day when I take an iron condor trade, it's basically 4 trades in one. It's not just one single, like, am I buying? Am I selling? There's 4 trades involved. Okay. And the first trade is we're going to start up here with the call. You're selling, remember, selling, because when you sell, you create premium. We're going to sell a call. Okay. And let's go ahead. I'm going to copy this, and I'm going to put this up here. And I'm also going to copy and that. Perfect. And we'll put this here. So you're selling a call. here. And then we're also selling, we're buying a call up here. Now, let me just type this out and then I'm going to explain. I just want to get this demonstration fully on here. And then down here, you're selling a put. Remember what puts are, right? Puts are the right to sell. And then you're buying a put. Now, I don't want to confuse you guys. I'm going to just type this out and then I'm going to explain what we're doing at each level. Okay. You're buying a put. Okay. This is all one trade. This is called an iron condor. Okay. And I'll explain why it's called, like why people named it the iron condor. And you can also look this up on like YouTube or you can Google it or you can watch it, wherever you watch stuff to get information. And there's other places that can teach you what an iron condor is. I'm going to do my best to explain it right here. So first things first, let's start right here with the call. So the call is where you collect premium from selling. If the market goes up, somebody who buys that from you is going to make money if the market goes up because they're buying the call. So you're on the other end of that trade where you're selling the call. Okay. Now, remember when you sell insurance to other people as the insurance company, you also need insurance because if you're wrong, you can get burned really badly if you don't also have insurance yourself. So what we do to protect ourselves is we create these wings on the other side where we also buy a call. Now, here's the thing. This call right here is closer to the money because the current price of the market is right in the middle. Let me actually draw that up. Let me make just a little thing right here. Let's just say current price. And we're going to use SPX because that is the stock that I use or the instrument that I use to trade the Iron Condor every day. Current price, let's say it's $5,000 SPX. Okay. Okay. So the current price is right there. Then, and I actually have one second, I have this. Okay, we're going to do this. Perfect. Okay. Then what we're going to do is so like I said, as somebody selling insurance, you also need insurance too. So you have to buy this call up here. Now remember, if the current price is in the middle, that's what you want as an iron condor. You want the market to stay in this middle area. If it stays in this middle area, you make money. If the market goes outside of this middle area, you're going to lose money. Okay. If it goes up or down outside of this line right here or this line right here, you'll actually lose money. And I'll talk more about that in just a second. Let's talk more about how you make money and how you just mechanically set up the iron condor. Okay. So you come in here, you sell a call. Let's actually label the prices of these calls. So let's do an example of a call at 5,025. Okay. And that's the strike price. Then for the buy side, let's do 5,000. It's going to be a higher price, 5,050. Okay. That is the buy price. Let me also just go ahead and fill these in down here with the puts, and then that will make more sense. Let's do say you're doing 49.75, and you can pick different strike prices, and we'll talk more about that in just a second. This is just for illustration purposes, and then we'll get this going. So 49.50 as our insurance on the other side. Perfect. This is good. Okay. Okay. So, like I said, it's four-legged trade. Up here, you've got your call that you're selling. You're going to receive premium for this. Let me actually do another. I'm going to go ahead and show you how much premium you receive as an example. Let's go ahead and show you what this looks like. Let's say you receive, for selling this call, you receive $2.50 per share. Okay, that's premium received. Let me go ahead and write that down. Premium received. Here, let's just do this. We'll just call it premium. There we go. And then I'll just make this bigger. Let me go ahead and copy that. Oops, 250 premium cap. Cap. Sorry, guys. I just wanted to make sure we fill this out. And you'll receive 250 on that side too. And then let me go ahead and just, once I fill this out, then this will make a lot more sense. Okay. And then you pay $1 here. And actually, let's just do this the official way. That's called a debit. So you're paying a debit, and then this is a credit. So you're receiving. There we go. Okay. We're almost there, guys. Copy that. And we'll just put this down here. Perfect. Okay. So this is like I said, with this, you're selling right here the call at a higher price than the current price where the market's at. So you think that by the end of the day, when I typically trade iron condors, I think that the market's not going to go above that price right there. And then if it goes beyond that price, I also need to buy insurance myself as the insurance company. And we'll choose as an example, we'll just say it's 5,050, and we're gonna buy a call at a higher price. So it's kind of like a hedge if you think about it. You have one price where you're selling and another one where you're buying. Why is it cheaper to buy this insurance that's higher? Does anybody know? Anybody have a answer to that? It's cheaper to buy the insurance because it's further out of the money. When you sell premium that's closer to the money, like when I sell this call that's closer to the current price, people are willing to pay me more money for that. It's kind of like if I'm selling insurance on a house and it's prone to hurricanes, all right? And I sell, house insurance and, block off the coast or something like that. And they're like, I need hurricane insurance, right? I'm going to collect more money because I'm closer to the current price of the market. It's more likely that the market could hit this price at some point. Then it's going to go up to this 550 number. The market's more likely to hit 525 sooner than it will hit 550, obviously. And so, because of that, this one doesn't cost me as much money to buy this call, but I need it in case the market blows through the top, right? Like, let's say the hurricane comes and it just totally wipes out a neighborhood that I sold insurance on. I need to be covered for that as well. I'm obviously going to take a hit because I'm selling this call right here at 525 and I'm collecting premium because of that, but I'm on the hook for everything between 525 all the way up to 550. Okay, does that make sense? And so that's why I have to have this insurance up here because if I don't purchase that insurance at 550, I'm on the hook for as far as this call could go. Like if 520, if the market goes not to 525, but let's say it goes to 6,000 or it goes to 500, 5,500, I'm on the hook for that entire amount, right? And so what this does by buying this insurance is it also gives me this kind of peace of mind knowing that the market can only go so far against me. So this is important. By the way, this is called a call credit spread. Okay. So with a call credit spread, it's just a two-legged trade. Um, and it's just where you sell a closer to the money call to collect premium, and then you at the same time in the same transaction you then also buy a call that's further out of the money. It creates a spread, and the reason why it's called a credit spread is because you're collecting premium, a net premium. That's why it's called a call credit spread. Okay. Now, to finish the iron condor, we actually have to sell what's called a put credit spread, which is this part down here. So what we're doing is we're creating two lines. We're saying, hey, I don't think the market's going to go above this, and I don't think it's going to go below this point. Okay, we want the market by the end of the day to stay right in between. We make the full credit spread premium if the market just stays right. That's basically we sell hurricane insurance. The hurricane doesn't come where it doesn't really affect us too much. We don't have a lot of claims at all, and we just collect the entire premium. That's what we want right in the middle. So let me explain this bottom part right here. So again, remember, current price of SPX is at $5,000. That's the price of the stock. Okay. Down here, we have a put that we're going to sell. This is the part that probably confuses the most people. They're like, wait, didn't you say with like puts that puts mean the market goes down? And that's true. If you buy puts, you hope the market goes down. If you sell puts, you actually hope the market goes up because on the seller, you're obligated to pay somebody else if the market goes down, right? Because if the market goes down and you sell a put, now you might have to uh, sell that stock at a, or you might have be on the hook to basically buy back that stock at a higher price than what it's actually than what it's currently at. And so that's why selling puts can be dangerous if you don't buy a put as well. So you buy a put that's lower in strike, and what's that going to do? It's going to be less expensive. Why is it less expensive to buy a put that's far out of the money like this? Well, it's because it's not likely to go there, right? It's not very likely. And so it's not going to cost you a lot of money to buy a put down there, right? Now, when you sell this put that's higher in its strike price and a little bit closer to the money, you're going to collect more premium. So you see this $2.50. That's the credit you're going to receive for selling that put. Okay. Down here, you have a debit that you're going to pay. You're actually going to take a dollar of that 250 that you received in credit to purchase insurance yourself as the insurance company. Okay. And this is going to protect you against catastrophic loss. So basically, if the hurricane comes and things just go crazy and you're on the hook for all this insurance that you now have to cover, you're going to be covered up to this point. You still have to pay the difference between 49.75 down to 49.50. So you got that like that risk there that you're still on the hook for. But anything below 49.50 is covered by the insurance that you're purchasing yourself. Okay. And again, the whole goal of this iron condor is to create a net credit. So between this up here and these down here, between the sell put and the buy put and the sell call and the buy call, it's supposed to create a net credit. Okay. So the total net credit between this, it's a you make $1.50 from the call credit spread, and then you also are going to make $1.50 from the put credit spread. So this iron condor, let me go ahead and type this out. Let me go ahead and copy this, and we're going to make so total credit. We're going to type this out. Total credit is going to be $1.50. So you're going to make $1.50 from the iron condor itself, because you're spending. Oh, excuse me, not $1.50. It's $1.50 on each side. It's $3 total. You're making $3 from the entire iron condor. Okay, that's how much you're making. Technically, you received $2.50 from the call, and you received $2.50 from the put, and that's a $5 total. But remember, you had to buy insurance on both sides. Those are your wings. That's what's protecting you. You spent a dollar on each side, so you created a net credit of $3. In fact, let's be a little bit more specific here. Let's just call that net credit. So net credit on the iron condor, like I said, is $3. Okay. And this is per share, by the way. When you trade options, you have to buy in contracts of 100 shares at a time. So whenever you go and quote out an iron condor, you're basically whenever it says like $3 net credit, you're actually receiving like $300 because you have to do it in contracts of 100. So if this iron condor expired worthless, you would collect that $300 net credit, and that would be free and clear. It's your money. You get to keep that. It's a beautiful thing. It happens most of the time. Obviously, the few times that the market goes outside of these ranges, it can get spicy and it can go against you, and it's not fun when that happens. We're just about to get to that part, how to do that. I'm going to show you my specific rules on how I trade this every day. But are we clear on like what the iron condor is, what we're trying to do? Let me pull up the comments section here. I think I missed. No, we don't have that many comments other than I missed this from earlier. Gerald says, "Are these covered options?" So they're not covered options in the sense that they're like covered calls. Like when you do a covered call, you're basically owning the underlying stock, and then you're selling calls against the stock that you already own. With this, it's covered in the sense that you're buying insurance to protect you as the insurance agent. Like you're the insurance company, you're selling insurance, you're collecting money every single day by selling that insurance. But you also yourself need to have some insurance in case things go crazy, right? Sometimes, like I've had a couple of iron condors, even in the last couple of months, where Trump will get out there and he'll say something crazy. And again, I'm not trying to be political. We don't get political here in these webinars. I'm just trying to state a fact. He'll say something, and the markets respond to what he says, obviously. And so, because the markets respond to what he says, if you're in an iron condor and the market goes crazy during that period of time, you could be on the hook for however far that market goes if you don't have insurance. Now, if you have that insurance and you buy a call on each side and you sell a put on each side that's further out of the money, you're going to be protected Obviously, there's still risk and there's money you can still lose, but you're going to be protected um, against total loss. So take a picture of this. If you don't have a picture, take a screenshot. This is the this is basically a prime example of what an iron condor is. Now I'm going to show you guys, we're going to go into my brokerage account. I'm going to show you guys how to quote out an iron condor in Robinhood. I'll even show you the trade I took today, and I'll show you how to take it tomorrow if you want to do this. And I'm going to give you some tips and tricks. We need to cover when to trade this, when not to trade this. We also need to cover like how to take the trade. And I'm going to show you how much money you need to be able to trade an iron condor. So people have asked me like, hey, Steve, like I would love to make $1,000 a day, or like you're doing, or I'd like to make 500 a day, or even just $200 a day. Like how much money do I need to do that? It's actually not as much as you think. So I'm excited to get into that part too. Um, yep, and we're going to cover the exit strategy, which is very important. Yep, we'll get to that. Okay, so let's jump over to let's go ahead and stop sharing the whiteboard. And let me pull this over here. Let's pull up Robinhood. Okay. And let me go ahead and share Robinhood. And let me know if you guys can see this on your screen. So I've stopped sharing the whiteboard. It should be Robinhood. Can you guys see that in the chat box? Okay, perfect. All right. So let's go ahead and show you how to do this. So the instrument that I use every single day is SPX. Okay. You can technically trade iron condors on anything you want. You could trade it on American Airlines. You could trade it on JP Morgan Chase. You could trade it on McDonald's stock or whatever stock you want to trade it on. And you could even trade iron condors that go a week out, a year out, a day out. I do zero DTE iron condors. What does that mean? That means same day expiration or date to expiration DTE iron condors. Okay, so you're basically coming in, you're pulling up SPX on your favorite brokerage account, and then you're going to click Trade SPX Options. This is what an option chain looks like if you've never seen one before. Inside of an option chain, you can basically select between buy, sell. That's easy to understand. You can either buy a call, you can sell a call, you can buy a put, or you can sell a put. Okay. So you're going to have to get familiar with the difference between that. I will help you. It's easy to understand. Um, but in the beginning, it might seem kind of intimidating. So what I typically do when I'm trading an iron condor is I'm trading same day expiration. Today is already over, so you can't see March 23rd in here anymore because the market already closed today. So the next expiration date is tomorrow, March 24th. So if we want to quote out an iron condor for tomorrow, we'll basically come in here and I'm going to show you how to quote this out. You could basically just start by selling the call. So you hit sell call and you're going to collect premium. So when I search through here, if I wanted to sell like this one right here at currently the market's at 65.81, that's the index value, it's the current price. If I sold this one at 65.85, I could collect $34.50 per contract or per share. And remember, a contract is traded in 100 shares at a time. So I would collect this amount times 100. So that'd be like $3,400 that I'd collect for selling that. And that's insurance. Like I'm collecting that premium if I sold that. So I could go ahead and click that right now. And then I could turn around and hit buy a call and I can go further up. I usually just go with the next level up is what I've done. I'll with some of my iron condors, I'll do $10 wings and I'll explain what that means in just a second. But let's just start by making this easy by just going up one level. So this is called a call credit spread, as I mentioned earlier. You're selling it closer to the money call. You're collecting premium for that. And there's the premium that you're collecting. And then you're buying a call that is further out of the money. This is the insurance that you're paying for. So you're collecting insurance, collecting premium, you're making money for selling that insurance, and then you're turning around and spending a lot of that money to buy insurance yourself. And then this is your net total credit. This is what you get to collect on this trade. Okay, so that would be a call credit spread. Then if you turn around and sell a put, Let's go below the current price. Let's go with 65.80 right there. And then we turn around and buy a put that's just $5. Just do a $5 wing. That's called a short iron condor. And the cool thing about Robinhood, and I love this about Robinhood, is it actually tells you exactly what you're about to do right here. So it's like, hey, this is a short iron condor. It recognizes that what you put in your shopping cart is exactly what you just described. So that's how easy it is, like in Robinhood specifically. You just come in here, you select your strike prices, and then it tells you beforehand that what you're doing is, that's exactly what you're doing. So, okay, let's go ahead and delete these out of my cart because I want to show you exactly how I do this. So what I do, here's my routine. So this is kind of the bread and butter stuff. What I do is I come in here every day at 10 a.m. Mountain Time. I think that's 12 p.m. Eastern. That's the best time to take a zero DT iron condor, in my opinion. And I'm going to explain why. I've done a lot of research. I've run this through the AI on multiple AIs to figure out the best time to trade a zero DT iron condor. For me, the best time to do it is at 10 p.m. Mountain or 12 Eastern. Here's why. Basically, 12 p.m. Eastern is the London close. So the markets are already cooling down for the day. At 12 p.m. Eastern time, that's also an hour and a half after the, that's 2.5 hours after the market open. So the stock market opens at 9:30 a.m. Eastern time. So at 12 p.m., that's lunchtime in New York. A lot of bankers start to go to lunch around that hour. The market's already been open for 2.5 hours. Historically speaking, most of the movement that happens in the stock market happens in the first 2 hours of the day. Okay, that's just a fact. That's just how it is. So you're basically coming from a high volatility regime in those first 2 hours, and then we're starting to go into a lower volatility regime at the end of the day. So we want to sell the premium, we want to sell the insurance while the hurricane is basically still there, but it's starting to go away. Okay, that's kind of the idea. This is the best environment to be selling this insurance. Okay, so you're selling insurance, and the hurricane's kind of slowing down, and you're like, okay, well, people are still thinking about hurricane insurance, but you're kind of thinking like it's kind of blown over. That's the best time to be selling. So that's why it's a very time specific strategy. You don't want to just sell iron condors just to sell iron condors. You want to go in when the volatility and the premiums are still high and people are paying top dollar for this insurance. Okay. It's very important to do that. And then you want to basically hold on to this insurance, this obligation that you have for at least a couple of hours while the volatility starts to shrink. So the market will actually close at 4 p.m. Eastern time. So if you sell an iron condor at 12 p.m., there's 4 hours left. I typically hold these for 2 to 3 hours. I never hold the last hour. I'm going to get into that in just a second. But you basically want to collect that time decay. It's also known as theta decay, where the option becomes worthless over time. What we're trying to do is we're basically saying, hey, I'm going to sell insurance for the next 30 days, and I'm just going to hold this for like 2 weeks. And then you'll basically pass on that insurance package to somebody else who wants to trade it, until expiration or whatever. But you're just trying to capture that first couple of weeks as an example. Of insurance premium is essentially the idea. So I come in here at 10 a.m. Mountain, 12 p.m. Eastern every single day, and I'm basically looking for the 10 delta. What does that mean? So I'm looking here, I'm going to go ahead and sell a call, and I'm going to go further out of the money, and I'm typically looking for the 10 delta right there. Basically, what does 10 delta mean? Let me explain real quick. The 10 delta basically means the chance of expiring in the money. Okay, that's all it means. Okay. So when I sell the 10 delta, there's a 10% chance that that option will get executed, and somebody who buys that option will be able to make money from it's basically their insurance that they're buying. Basically buying insurance on something that probably isn't going to happen, but they're buying it anyway just in case it does happen. And you're basically turning around and saying, hey, there's a 90% chance that this option is going to expire worthless. So I'm going to sell this option because I want to have this high probability chance that it's going to expire worthless. So I typically look for the 10 delta. And I know that's something we didn't really discuss today because we don't have the time to, but I'm looking for stuff that has a 90% chance of profit. So when you come in here in Robinhood, it's easy to find. I'm looking for something that's going to expire by the end of the day with a 90% chance of profit. Okay. Then you basically hit that, add it to your cart. That's the premium you're going to sell. Then you're going to go ahead and buy a call. I usually just go $5 up on the wings, sometimes up to $10 up. Let's just go $5 for now. That's going to create a credit spread, okay, a call credit spread. Then we're going to turn around and we're going to sell a put, and we're going to go down this time because we got to go out of the money, and we're going to go down out of the money. We're looking for a 90% chance of profit. Okay. And that's going to be the 10 delta. It's about right there. We could even go with this one at 64.55. Let's do that one. And again, that's about 10 delta. Perfect. We'll go ahead and add that to our cart. Then we need to go ahead and buy a put that's just below that $5 wing. Again, there's your credit spread. Okay. This is called short iron condor. And this is the trade right here. So let me kind of show you kind of and then we need to get into how to exit the position. But Robinhood is super cool because they show you how much money you stand to make and how much money you could potentially lose. So something you should know about iron condors is they have a little bit of an upside down RR ratio. And that makes sense, right? Because if you're the seller of insurance, like if I sell you car insurance, okay, and you pay me a premium, and let's say you pay me 200 bucks for this car insurance for the month. If you get in a car wreck, who owes the other person more, right? Like you paid me $200, but now I owe you thousands of dollars, maybe tens of thousands of dollars, depending on how bad the wreck was. Okay. So obviously I'm on the hook if this event that's not likely to happen, if it actually happens, I'm on the hook and I'm going to pay you more. The good news is it's defined because we have insurance against this ourselves. But basically, if the market stays in between this strike price and this strike price right here, you can see it right here. It says 64.55 and right here, 66.85. If the market stays in between these two numbers tomorrow, we're going to collect $100 in premium, free and clear, the whole amount, like that basically means there was no car wreck, there was no hurricane. We just collected the premium. Okay. Then, if the market goes outside of this range, either below this or above this price right here, we will owe this person money. And the max loss is $400. So it is upside down. I just want to point that out. It's very important to know that about iron condors. If you allowed this to go to expiration and you didn't close it beforehand, you would be on the hook for $400 if this was wrong. And then if this market if the market stayed inside this price, you would collect, like I said, $100. So, any questions on the max profit versus max loss? So this is an important detail to recognize right there. Now, a lot of people might be turned off by this and be like, well, I don't want to risk $400 just to make 100. Well, here's the deal. You're basically betting on something that has a 90% chance of success. And I've actually been able to create a 93% I have a 93% win rate with these iron condors because I'm selecting 10 deltas or 90% max chance of profit. And because I've also added filters that help me know which days are good and which days are not good to trade the iron condor. That's how I'm able to get a 93% chance of profit. That's why when you guys see me post on Facebook, you're like, how is Steve winning all the time? It's because it has a 93% chance of success. So even if I lose, and every once in a while I have to pay out insurance on people who come with me with a claim, I'm making so much money from collecting premium every day. And every once in a while, I'll have to, in fact, I'll post it. Like, I don't mind posting my losing days. Like, if I have a losing day, like, I'll post, I'll be like, hey guys, like, I lost today. And I'll actually show you most days I don't lose the max profit because I usually turn around and if we have a day where it doesn't look really good, I usually sell the insurance back to the marketplace before expiration, and I'm never usually going to max loss anyways. So, all right, very cool. So I did have one more thing I wanted to show you. Oh yeah, I wanted to go over when to close this. So I have some very specific rules. Let me actually pull up. First thing you want to do. Let's talk about the entry first. What days you should trade this and what days you shouldn't. First thing you got to do is I use Forex Factory to look up big news events. So I'm looking for big red folder news right here. And if I see that there's US dollar news that's happening after 12 p.m. Eastern time, between 12 p.m. and 4 p.m., that's a no trade day. So things like FOMC meetings, if you have a day where there's like a rate statement coming out, that's a no trade day. So we had that last week. So on Wednesday, I didn't trade iron condors. You might, maybe some of you saw that I didn't make any money with iron condors on Wednesday. It's because I didn't even trade on Wednesday. There's just so much extra risk on those types of days. That's basically like there's a level 4 hurricane coming into the coast, and you're asking me to insure, you know, right before the hurricane. And I'm just like, that's not my business. I can't take on that risk. I'll let somebody else take on that risk. So on those types of days where we have tons of news, lay off the iron condor. Okay. So always check Forex Factory first, just forexfactory.com. See what kind of news is coming out. Today we really didn't have much. Tomorrow there's a lot of news, but it's with different currency pairs and different like it's non-US news. We really don't have any like big US news between here and here tomorrow. We do have Australian CPI, so inflation data that comes out tomorrow night, but that's after the market closes, so I don't expect that to affect the S&P 500. So tomorrow is a good day. Wednesday is a very clear day. The only thing you also want to check for is like right now we've got a war going on, so that's been a little bit of an interesting dynamic. If the market is going up big or down big on a day where there's a lot of war news, you may want to lay off the iron condor, but it's a little subjective that way. Today we had some news and I still traded the iron condor and I did fine. So even when the volatility is high, sometimes that volatility can benefit you. Another thing you want to check for is the VIX. Okay. So you want to go to the VIX. VIX is a volatility index. If the VIX is sloping down, like if it's having a down day, like right here, this was on March 20, this was today actually. Yeah, today it sloped down at the end of the day. That's a good sign to trade the iron condor. If you have a day where the VIX is sloping up big time, like right here on the 20th, that's usually not a great day for condors. You can still do it, but it's typically not the best day. So usually, again, you can take those on a day-to-day basis. But if it's sloping up pretty good and the stock market's going down, usually those are days you might want to like stay off the iron condor and maybe come back the next day. But if you got a VIX that's kind of slowly declining and it's having a down day, that's usually a good day to trade iron condors. Okay, so there's some filters for you. Lastly, when do you get out of the trade? So I always close my iron condor. I have a hard cutoff. The hard cut, write this down. The hard cutoff is 3 p.m. Eastern time. Okay. I never trade that last hour of the day. There's way too much gamma risk. There's way too many end of day Trump announcements or Fed announcements or what, or you name it. Also, in that last hour of the day, that's when brokerages around the world and around our country settle margin calls. They settle their books in that last hour of the day. And that's a terrible time to own iron condors because your iron condor could be 80% of the way to max profit in that last hour of the day. And there's only 20% left to squeeze out of the market. And it can resurrect. And you don't want your option to resurrect in that last hour of the day because you've essentially earned, 80% of the option's value by the end of the day. And if the market goes crazy in that last hour, an option that was essentially worthless now becomes super valuable, and that's not what you want. You were trying to collect premium. We're trying to collect income. And so we don't want the market to go do those crazy things at the end of the day. So there's a hard cutoff at 3. Now there's one more thing you got to know. When your option gets to 50%, 50 to 75% of max profit, that's typically when you want to close. That usually happens around let's see, that typically for me that happens around 2 p.m. Eastern. So at 2 p.m. Eastern, usually 2 hours into the trade, I'm usually 50 to 75% of max profit. That's time to close the trade as well. and then with a hard cutoff at 3 p.m. Eastern. One more thing. If you get to 2 p.m. Eastern and the option has not gotten to 50 to 75% of max profit, and you're either at break even or you're even losing money on the iron condor, that usually means that one of your strike prices are being threatened. And if it's being threatened, it's time to close the trade. That basically means a hurricane's coming in, and we're not all about selling high risk insurance premiums. And so that's just not the business I'm in. And so I'd rather pass on that option to somebody else who is in that business of selling high risk insurance premiums. So we'll pass it on to somebody else who wants to buy it from us. So if you get to 2 p.m. Eastern and the Iron Condor has gone up in value, which is not a good thing, you want it to go down in value. It's time to close the option trade. So anyway, that's another hard and fast rule. So let me leave it open to you guys for just a minute or two to ask some questions, and then we'll go ahead and wrap up. Um, but that's basically the trade I take every day. And I do actually have a few more things I want to show you guys, but go ahead and ask your questions, and then and we'll wrap up with a few things on my end. Roger says, is this the night before? Yeah, so I'm just showing you like in the option chain right here how to set this up for the upcoming day. Because here, let me go back to SPX because today's options have already closed, so I can only show you tomorrow's. And and then if you wanted to trade again, you can't trade today because only tomorrow's available. You can also trade, in 2 days out, 3 days out. I don't typically do those. I do same day expiration. Oh, that's a great question. So Loma is asking, how much capital do you need to start trading an option? Yeah, let me go ahead and show you this example one more time. And let me show you the capital that's actually, it's going to blow your mind. You don't need a lot of money to trade these iron condors. So if you sell, let's go ahead and sell let me go ahead and show you an example of this again. This will be real fast. I'm going to buy this, put this in the shopping cart. Let me show you the actual cost to do this. So sell a call. Let's go further out of the money. Let's go right there and let's go ahead and buy a call right there. Perfect. So there's an iron condor. So for this example that I'm showing you right here, you need $405 of max loss potential to make $95. So a good rule of thumb is for every contract you want to trade, you need about $500 in your account. So a minimum to be able to even just take an iron condor trade, you need at least 500 bucks in an account. Okay. And yes, if the iron condor trade wins, you'd make like a 20% return a day, which obviously is not sustainable. I get that. I'm just trying to show you the minimum required. If the trade lost and went to the expiration and you lost money and you didn't close it during those time windows I told you to close it, you could potentially lose like 400. Well, the max loss is $405 per contract. At least that's what this is showing right here. That's pretty typical. So, if the trade lost, you could lose pretty much the entire amount that you put in. If you put in $500 and it went the wrong way, completely the wrong way, you could lose, $400. Um, let's say you want to average like $200 a day or $300 a day. You're probably going to need somewhere between a minimum of $2,000 to $3,000 to be able to make $200 to $300 a day. And that's if you're willing to risk, because you are going to be risking for every contract you trade, you are risking about $400 to $500 per contract. So if you traded like, let's say 4 contracts, you're probably risking somewhere between $1,600 and $2,000 total. And so you'd have to be willing to lose that if the trade went the wrong direction. So you have to keep that in mind. Um, I mean, it's just risk to reward stuff, right? Yeah, even like, yeah, 50 to $100 a day is a good place to start. Guys, what I typically do with my traders, if you're not one of my traders, hear me out on this. You don't necessarily need to start with real money. You can actually start with a demo account. Like you can go in and open up a demo account with not Tasty Trade. Let's see who does demos. Interactive Brokers does demo accounts. Also, Thinkorswim does options demo accounts. You can get a demo account and start practicing. You can start taking these iron condor trades that I take every single day. You can practice them. Okay. So with Schwab, you can do it. And then I like Robinhood. They only do live accounts. Robinhood's great. Weeble's awesome. Tasty Trade's a good place. You can do live with Thinkorswim if you want to do it there. You can go live with Interactive Brokers. I like Robinhood for the live accounts personally. It's my preference, but it's up to you on what you want to do when you want to go live. So I highly recommend that you trade the Iron Condor with me for at least a couple of weeks in a demo account, and then let's get you into a live account. So one more thing I wanted to show you guys, and thanks for sticking around because I know it's not the easiest thing to stick around. Um, I actually post when I take an Iron Condor trade. Most days I actually post the Iron Condor. So I have a Telegram channel where I post the trade, so you guys can actually see the trade that I post. So it typically looks like this. I'll say like, "Hey guys, here's my Iron Condor setup for today." I'll show you my call that I'm selling, my call that I'm buying, the put that I'm selling, and the put that I'm buying for my insurance, and then the credit that I'm receiving. So I actually tell you exactly which ones I'm doing. And then I tell you, hey, I have a hard cutoff close at 3 p.m. Eastern and just some other things. If there's any other things I need to include, I'll include it. So you can actually take the same trades that I'm posting right here directly in Telegram, which is super great. So you can get access to this in my Telegram channel. You do need to be a member of our program. And I actually wanted to just provide, I'll do this real quick and I'll still answer questions, but let me just get this out of the way. So if you want to join our program and get access to our options trading webinars that we do every single Monday, and if you want access to the Telegram channel where I post these signals, you can get completely coached and get all the information you need. You can join our program. I actually made a promo code specifically for the Iron Condor. So if you join my VIP program, which is right here, it's $249 a month. I made a promo code that you can use just for today only. You can join the program with $100 off. Actually, if you click join right here or select, let me go ahead and refresh this, and then you select this and pull up the checkout page right here on the um, coupon side. If you use code Iron Condor, you can save $100 on your first month. And I'm not sure why this isn't loading right now. I do apologize. Let me see if I can get it to pull up one more time. But yeah, if you use code Iron Condor in the coupon code or the coupon code space, again, that will save you $100 on your first month. And so that should help you kind of get started. You can book a call with me and I'll help walk you through how to take the Iron Condor trade and you can start coming to some of our classes. And again, I don't know why this isn't working right now. It's so funny. I'm like trying to get this to work and it's like not pulling up for me. Maybe it's working for you guys. I don't know, but yeah, I'll give that a second. But yeah, when you get to the checkout page, just use the words Iron Condor. That'll save you $100. Okay, let me go ahead and answer the rest of everybody else's questions here. Let's go back to Robinhood. So yeah, even if you just wanted to like get started with just a small amount of money, even $500, you can start making 50 to $100 a day. Obviously, if you have a losing day, you could lose the $400 or $500 if you had a losing day. So keep that in mind. And so you may not want to just trade with just $500. You may want to have like $1,000 total on standby. So in case you had a losing day, you could come back in and start getting back, start earning that money back on a losing day. Again, if you follow the rules I've given you guys, you should win these trades 93% of the time. And if you're not, let me know, and I'm sure we can shore that up easily for you. So let's see. Paul says, "How do you set up to close trades when they hit 70% in Robinhood?" Yeah, that's. Let me see if I can give you an example of that. I don't have an Iron Condor trade pulled up right now, but let's say I wanted to close like here's a put I sold last week. This isn't the Iron Condor. You basically click on the option that you have open and like, for example, this is the bid and ask price on Pfizer. This is a put I sold on Pfizer, and it's currently worth 10 cents right now. Let's say if it was worth 5 cents, I would just type in 5 cents, and that would be the limit order you put in, and you could hit buy to close. and you can hit review order, and it will tell you like, hey, if you want to close this Pfizer trade when it's only worth $5 left, you can go ahead and hit review order. And then that's how you would set the limit order to close the Pfizer trade, or in this example, the Pfizer trade. But if you wanted to close the Iron Condor, you would just put in the limit price that you wanted to close the Iron Condor for. You just go and click on the option itself over here in Robinhood, whichever option you have open, and then you just go and put in the limit price, review order, submit, and that will give you a limit order. You can so that way you can close at 50 to 75% of max profit. So Cassidy says, are you basing your bet size depending on your portfolio size? Yeah. So it really there's couple of ways you can do that, right? Um, so I actually do it based off of an income approach. Like I'm trying to make $1,000 a day. And so I will typically to make $1,000 a day, you typically have to put up somewhere between 4,000 and up to $10,000 in risk per day. And yes, that's a lot of money that you could potentially lose. But again, I look at it like this. If you have a 93% chance of success, yes, every blue moon or even two blue moons, you might lose, um, $8,000 in a day. And yeah, it stinks if that happens, but it's super uncommon. Like it's so, especially if you follow the filters I've put into place, because I've been doing this for a while. If you put in those filters, it's very rare that you would actually hit max loss. Extremely rare. Even on a losing day, like even most losing days I have are like tiny. And so it's really most days you're just collecting the premium. So I do it by an income approach. So if my goal is $1,000 a day, I typically need to trade about 10 to 20 contracts or 10 to 15 contracts to be able to make $1,000. Um, and yes, I am risking, in theory, there's up to like $8,000 I could lose if I'm wrong, but it's a risk I'm willing to take. And so you kind of have to ask yourself, if this money were to blow away, am I okay? And if you're not okay, then you need to lower your contract size. So that's a good rule of thumb. If you're trying to figure out like how much you should put into it, always just invest what you can afford to lose. If you can't afford, if you're like, I need this money for rent, I need this money for my mortgage, you should keep saving money until you have enough to trade a couple of contracts that you'd be okay losing if the trade didn't go the right direction. So, okay, let's see other questions. These are good questions. Appreciate it, guys. Okay, I think that's pretty much all of them. So, okay, great, guys. Well, I appreciate each one of you. I think that's about it. We kind of went a little overtime, but I wanted to make sure that we really covered this and helped everybody. If you are still confused, this is recorded. You can come back and watch this later. The other good news is I'm available. So this is what I do for a living. I trade full time, and if you need help learning how to trade the Iron Condor, I'm available and happy to help you succeed in your journey trading. So, all right, guys, well, have a fantastic rest of your evening. Thank you for coming, and we will see you guys in the next webinar.